There are 5 numbers that separate the entrepreneurs who build real wealth in commercial real estate from the ones who lose money on it. If you don't know these 5 numbers, you have no business making an offer on a commercial property. Most agents won't teach them to you. Most lenders assume you already know them. And the result is business owners walking into deals on instinct that should have been killed before they ever signed a letter of intent. Today, I'm going to fix that. By the end of this video, you'll know exactly which numbers to ask for, what they mean, and how to use them to make a real decision on a real building. My name is Lexi Sims. I'm a Houston commercial real estate agent. Let's get to it. Quick context. If you saw my first video, you know my whole focus is helping entrepreneurs stop renting and start owning their commercial space. The asset that gives you the choice, the building that pays you whether you keep working or not. But none of that works if you don't run the right numbers on the right deal. A bad commercial deal is one of the fastest ways an entrepreneur loses money. A good one that actually pencils out, is one of the most reliable wealth builders in business. These 5 numbers tell you which is which. Here they are: NOI, cap rate, DSCR, cash on cash, and GRM. Let's go one by one. So, number 1, NOI, net operating income. If you only learn one number from this entire video, make it this one, because every other number is built on top of it. So, NOI is what a property makes after paying its operating expenses, but before the mortgage ever touches it. So, a formula for that would be gross rent minus operating expenses equals NOI. Now, let me show you with real numbers. So say you're looking at a small commercial property. The rent roll across the building is $10,000 a month. That equals $120,000 a year in gross rent. The operating expenses, so things like property taxes, insurance, maintenance, property management, utilities that the landlord covers, let's say those run $24,000 a year. So $120,000 minus $24,000 equals an NOI of $96,000. So why does this matter to you as a business owner? NOI tells you whether a property can carry itself. If the tenant's rent covers the building's operating expenses and a chunk of the mortgage on top of it, your business operates in that space essentially for free. Now, one warning before we move on. Sellers and listing agents will sometimes hand you a pro forma NOI. That means the projected NOI if everything went perfectly. Vacant units fully leased at the top of market rent, no expense overruns, no turnover. Do not make a decision on pro forma. Make a decision on the actual NOI based on the trailing 12 months of real income and real expenses. If a seller can't give you trailing 12, that's information. That tells you something about the deal before you even run the rest of the numbers. So, number 2, cap rate or capitalization rate. This is the one every commercial investor throws around and almost nobody explains correctly to a business owner. So the formula for this one is NOI divided by purchase price equals the cap rate. So if our property has an NOI of $96,000 and the asking price is $1.2 million, that's a cap rate of 8%. Here's the analogy I want you to lock in on. Cap rate is to commercial real estate what an interest rate is to a savings account. It tells you how hard your money is working. A 4% cap rate means the property is generating 4% of its purchase price in annual income before financing. An 8% cap rate means it's generating 8%. So, higher cap rate equals higher potential return, but often more risk, more work, or a less desirable location. A lower cap rate equals more stable, in-demand property, but you're paying more for every dollar of income. The single most important thing about a cap rate is this: never look at it in isolation. You always compare it to what similar properties in that submarket are trading at. If the market average for comparable buildings is 6% and this one is at 8%, then that gap becomes the conversation. Why is this property cheaper relative to its income? Is it deferred maintenance, tenant risk, location, or did the seller just misprice it? Sometimes a higher cap rate is the deal. Sometimes it's a warning. And that's what a real advisor is supposed to tell you the difference between. Number 3, debt service coverage ratio or DSCR. This is the number that gets your deal approved or killed before it ever makes it to closing. Your lender lives by this number. So the formula is NOI divided by annual debt service equals DSCR. And annual debt service just means the total mortgage payments you make in a whole year on the loan. Most commercial lenders won't see a DSCR loan of 1.25 or higher. That means the property has to earn 25% more than it costs to pay the mortgage. So here's a real example on that same property with the NOI of $96,000. Let's say with 25% down on a $1.2 million property, your annual mortgage payments work out to roughly $72,000. 96,000 divided by 72,000 equals a DSCR of 1.33. That's above 1.25, so the lender says yes. If your NOI was 85,000 on that same mortgage, that's a DSCR of 1.18. Lender says no, not maybe, they say no. There are two things you need to understand about DSCR. The first, DSCR is property specific, not borrower specific. So strong personal financials won't compensate for a weak DSCR. The property has to carry itself. Even if you have $5 million net worth, the lender still wants this property's income covering the property's mortgage. Number two is a DSCR below 1.25 isn't always a dead deal, but it is a negotiating tactic. If the income doesn't support the asking price, the price needs to come down. I've used DSCR to get sellers to drop hundreds of thousands of dollars off an asking price because the math is always the math. So run DSCR before you fall in love with the property, not after. The number of business owners who emotionally commit to a building and then find out a lender won't touch it is staggering. Don't be that person. So number 4, cash on cash return. This one is the most personal because it's the one that tells you what the deal actually does for you. So here's the formula for it. Annual pre-tax cash flow divided by total cash invested equals cash on cash. And the annual pre-tax cash flow is your NOI minus your annual mortgage payments, and the total cash invested is your down payment plus closing costs and any other upfront capital improvements to the property. So let's run the numbers on this one as well. We'll use the same property with the NOI of $96,000, annual debt service $72,000. So your pre-tax cash flow is $24,000 a year. Say you put 25% down on the $1.2 million property, that's $300,000, and say $20,000 in closing costs, your total cash invested is $320,000. So you have your $24,000 divided by $320,000 equals a 7.5% cash on cash return. So why does this number matter specifically to entrepreneurs? Because this is the answer to the question, what is this money actually doing for me? If your cash is sitting in a savings account at 4% and this building gives you 7.5% cash on cash, that's almost double the yield before you even factor in things like equity and appreciation. And here's where it gets even more interesting. If you used SBA 504 financing and only put 10% down, let's say $120,000 plus $20,000 in closing costs, $140,000 total cash in, that same $24,000 in annual cash flow now becomes a 17% cash on cash return. That's the door the SBA loan offers. I'll do a full deep dive on that loan in next week's video. But the bottom line here is that cash on cash tells you what your money is doing in this specific deal. And it's the number you compare to every other place you could be putting that money. Number 5, GRM or gross rent multiplier. This is the back of the napkin number, the one I would run first before I bother going too deep on anything else. So the formula for this one is going to be the purchase price divided by the annual gross rent, and that gives you the GRM. So using our same example, $1.2 million purchase price, $120,000 annual gross rent. For that, the GRM is 10. A lower GRM is better. A GRM of 8 means you're paying 8 years of gross rent for the property. A GRM of 15 means you're paying 15 years of gross rent for it. So the GRM is fast and dirty. It doesn't account for expenses. It doesn't account for financing. It doesn't account for vacancies. It's a filter and not a final answer on whether or not a deal makes sense. But I use it constantly when I'm looking at a list of properties. I run GRM in my head before I waste a lot of time on the full analysis. If the GRM is way too out of line, then I would typically move on. A good rule of thumb in most commercial markets is a GRM between 6 and 12 for most asset classes. Outside of that range, I'm looking for a specific reason as to why that is. So GRM is the filter. The other four numbers are the analysis. So how do these five numbers actually fit together? Here's how I run them when I'm advising a business owner on a real deal. I would start with the GRM, that quick filter. Is this even worth taking a closer look at? If yes, then we keep going. Then we move on to NOI. What is this property actually making? Pull the trailing 12. If the NOI is real and verifiable, then we would continue on. Then it would be the cap rate compared to comps in the market. Is this a fair price for this income? Is there a reason for the gap? And then we proceed on over to the DSCR. Will a lender finance this? At what loan to value? At what interest rates? Running the numbers at multiple structures for that. And then the cash on cash, what does the deal do for the specific entrepreneur with the specific cash that they have to invest with the specific financing that they'll be qualifying for? If all five numbers point in the right direction, that's a deal worth making an offer on. If even one points the wrong way, that's information. Sometimes that information becomes a negotiating point. Sometimes it becomes a next deal. Sometimes it's a hard pass. But you never make the decision on instinct. You make it on these five numbers. If you're a business owner watching this and you've been thinking about buying commercial real estate, save this video, send it to your accountant, send it to your business partner, send it to your spouse. Make sure everyone making decisions with you understands what the math actually looks like. If you want me to run these five numbers on a specific property you might be looking at, the link to book a call is in the description, and that's exactly what I do. I run real numbers on real buildings for business owners across Houston, and I tell you whether or not the deal makes sense. Next week, I'm breaking down the SBA 504 loan, the financing tool most entrepreneurs have never heard of, that lets you buy commercial real estate with as little as 10% down. So you definitely do not want to miss it. Subscribe, hit the bell, and drop your biggest question about any of these in the comments. I'll be sure to read through them all. And if we get a lot of common ones, that might lead to a future video as well. Again, I'm Lexi Sims. I'll see you in the next video.